Welcome to Market Movers. I'm Jim Uriel, and we're just days away from a Fed meeting in which the market believes they're going to tighten. There's also no shortage of backstories as we had the James Comey testimony today. Now we're going to look at the ZN weekly options as a way of hedging risk or increasing exposure to these events. Joining me is Chief Investment Officer at Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay, so everything that's going on. Now, is the Fed going to tighten just because they said they were and they have the market convinced? Because there's been some somewhat bad numbers over the last couple months. Or should they really be tightening?
Well, I think they should be tightening because we've moved off of zero interest rates. The economy has shown some life. But regarding whether they've told the market they're going to tighten and whether they should because they did that, that to me isn't a great Federal Reserve because I believe this Federal Reserve has regained some credibility by the fact that they've been transparent but also willing to look at concurrent economic data to say whether they want to move or not, which means they can always change their mind.
Okay, you saw the testimony today. There seemed to be no smoking gun. Volatility came off, gold came off, stocks rallied a little bit. Is that yesterday's news now?
I believe it is, and I think it's about time it was yesterday's news because, my goodness, do we need to move on. So as we get further away from these testimonies, if anything does come as far as fallout, it'll just take a few days, and then we can move forward on the agenda that was promised.
Okay, now before we dive into our trade discussions, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements are going to vary. When we price this out, the SEP 10-year was trading 126.13-ish. Scott.
So you talked about the ZN, and when you're talking about the ZN, you're talking about the amazing move that the ZN has put in really since the beginning of the year now, and it just off recent lows in yield on the 10-year. So looking at the week 3 June, so this will take you past the next FOMC meeting with respect to maybe whether they make the decision on interest rates. I looked out at some of the option prices and found something that I thought was relatively attractive from a price standpoint, because that's what I believe you should always do when it comes to looking at trades is where can you get the appropriate price risk return ratio for what you believe your exposure should be. So specifically, Jim, I was looking today at the week 3 June 126.5 because they're priced in 30 seconds, 126.5, 1 in 27 call spread. This will cost you approximately 9 ticks to put on, expires Friday, June 16th, and it risks 140 to make a potential 360 because I believe we're in this new regime of interest rates where rates are going to continue to come down even if the Fed does hike because of this agenda that's been put off so long that the market's not believing is going to come through.
I'm not sure I agree with the direction, but I agree with the way you're doing it. It doesn't risk very much and has a pretty decent reward.
Pretty close to where the 10-year is trading right now.
Exactly. So I'm looking at buying the week 3. That's the same date. Now that's the Friday the 16th. They have launched. They do now have the Wednesday options that would expire the day after the meeting. They just launched a week ago. Had an impressive launch and have pretty decent volume. And I'm going to be watching that going forward. But I'm still sticking with the Friday mostly because I like those 2 days after the meeting. So the Friday 125 and 3/4, 125 and 1/4 put spread. This is the other direction. Now those strikes, 125 and 3/4 comes out to 125.24 because 0.24 is 3/4 of 30 seconds. It trades 30 seconds. They make this complicated.
You're good at
the
math.
125.08 is the strike on the downside. This trade also expires June 16th, and the SEP is the underlying. It risks $78, 5 ticks you pay for potential to make 422.
So different expression of where we believe that the 10-year is going to go. And you're going to get, I believe, a shot here at something because the volatility in the 10-year has been pretty wild. We talked about the move down so far in yields this year, but regardless, with respect to where yields are now and where some of the trading has been in recent days, I believe the market is going to give you some opportunity here to maybe manipulate either one of those trades.
I'm not positive I think yields are going back up. I kind of think they are because they've come far fast. But I do think we're passing some things that the market was worried about. That we also have the election in the UK too, and I think we're pricing in some concern of that. But I do think the risk reward on is what attracted me the most. 5 ticks to make a potential 32 ticks.
And I believe that's something that volatility gives you as well. In today's markets, you can get some nice risk reward for the positions you put on.
Because of the low volatility.
Absolutely.
Thank you for joining us in this special edition of Market Movers. I'm Jim Uriel, where we're helping to make you a better trader.